All right, let's dive right into this explainer. We're going to demystify the completely legal machinery that the ultra-wealthy use to avoid taxes, without breaking a single law. If you've ever stared at a headline about billionaire taxes and felt this wild mix of confusion and frustration, well, you are definitely not alone. Today, we're breaking down exactly how it works. And to be clear, we aren't looking at shady backroom deals here. We're looking at the actual printed U.S. tax code and the brilliant, honestly kind of baffling ways it allows the richest among us to protect their fortunes.
Let's start with a number that, frankly, just shouldn't be possible: 0. In 2007, one of the richest men in America paid exactly $0 in federal income tax. Just let that sink in for a second. $0. And here is the absolutely crucial part of that fact. Neither he nor the billionaires who did the exact same thing in the years following broke a single law.
Now, I want to be super clear here. This isn't a story about illegal tax evasion. Evasion is, hiding cash in duffel bags or lying on government forms. It's risky, and frankly, it's boring because people eventually get caught. This explainer is about tax avoidance. We're talking about a perfectly legal system that was purposefully built to treat their money completely differently than yours. It's literally the system working exactly as designed. Let's anchor this with a real-world comparison to put it in perspective. Take a nurse making, say, $60,000 a year. She's paying around 20 to 22% on her top earning dollars to the federal government. But on the flip side, a widely reported analysis shows a billionaire's true tax rate, meaning the tax they actually paid compared to how much their wealth grew that year, is closer to just 3%. How on earth can someone worth billions legally pay a smaller share than a nurse? So your first instinct is probably, okay, they've got to be cheating. But the real trick, the foundational secret here, is that billionaires barely have a salary at all. Famously, some of the most powerful CEOs and founders in the world take a salary of just $1 single a year. And they aren't doing that just to be humble, even though it's great PR. They're doing it because a traditional paycheck is the most heavily taxed money on earth.
So let's get into income versus wealth.
To really grasp how the ultra-rich navigate their money, we have to completely separate these two concepts, because the government certainly treats them like totally different species. Income is money that moves to you, like your paycheck. The exact moment it lands, bam, it gets taxed. You never even touch the full amount. But wealth is stuff you own. Think stock, a business, real estate. And the absolute golden rule of the tax code is this: you are only taxed when you sell that stuff. If your house doubles in value, you don't get a tax bill for that growth until you actually sell the house. On paper, sure, you're richer. But to the tax code, nothing has happened yet.
In the finance world, this paper growth actually has a specific name. It's called an unrealized gain. So if a tech founder's stock climbs by $20 billion in a single wildly successful year, that is an unrealized gain. And because there was no sale, they owe absolutely zero tax on that $20 billion. Literally, no sale equals no tax. But wait, this brings up an incredibly obvious question, right? If selling the stock is the exact trigger that causes a massive tax bill, and they refuse to sell, where does the cash actually come from? I mean, how do you buy a $200 million super yacht or, a fleet of private jets with stock you refuse to sell? To answer that, we need to look at the core playbook of the ultra-wealthy. This is the exact strategy that makes their fortunes effectively untaxable for life. It boils down to 3 simple words: buy, borrow, die. Let's break down exactly how this mechanical loop actually works.
Step 1, buy.
Step 2, borrow. Here's how these pieces actually lock together. You buy an asset and let it grow to, say, $100 billion in company stock, but you never sell it. Instead, banks will practically fall over themselves to lend you money. You just pledge those shares to a bank as collateral, and they happily hand you millions in cash to live an incredibly luxurious life. And this right here illustrates the central loophole of the entire system. Legally, a loan is money you owe, not money you make. Because you eventually have to pay a loan back, the tax code does not consider it income. So the billionaire spends the bank's money completely tax-free, while their actual fortune just sits there, completely untouched, continuing to grow. The math on this is just wild. Because they're borrowing against such massive wealth, banks hand out incredibly low interest rates, say 3%. Meanwhile, their underlying wealth, sitting there unsold, might be growing at an average of 8% a year. The growth literally outpaces the cost of the loan, meaning the loan pays for itself. It is the most comfortable form of debt in human history. But you're probably thinking, okay, eventually the loan comes due, right? Eventually the tax man catches up. Well,
Which brings us to step 3, die.
Okay, it sounds a little grim, but mechanically, this is the most powerful move in the entire wealth preservation system. When a billionaire dies and passes their assets to their heirs, this incredible tax provision called the stepped-up basis kicks in. It resets the value of their assets to whatever they are worth on the exact day of death. Imagine $1 billion in growth that was never taxed because it was never sold. The second they die, that entire taxable gain is completely erased, reset to zero.
so let's follow the full airtight cycle here. They buy assets, so the immense growth is completely untaxed. They borrow against those assets to fund a lavish lifestyle because legally, bank loans aren't income. And finally, they die, allowing the stepped-up basis to wipe the slate perfectly clean for their kids. It's a complete financial life taxed to close to nothing from beginning to end.
And hey, it's not just the tech founders who get to benefit from this system. The professionals managing all this money, they're cashing in too. Through a tax provision known as carried interest, investment fund managers can have a massive chunk of their pay legally treated as an investment gain rather than a regular salary. So mechanically, this lets them score a significantly lower tax rate than the working-class people who literally clean their office buildings.
And for true family dynasties, we see perfectly legal, super complex structures with names like Gratz and dynasty trusts. These allow families to quietly shuffle appreciating assets out of their taxable estate. It's basically like putting a giant protective force field around the money, locking immense wealth away from the taxman, not just for a lifetime, but for over a century. It ensures the fortune passes down completely untouched through generations.
So, why does it never change?
Look, none of this is hidden in the shadows. It is printed right there in the U.S. tax code for anyone to read, which leads to the obvious question, if everyone knows about this, why on earth hasn't it been fixed? Well, there are 3 honest, mechanical reasons. First, taxing paper money, those unrealized gains, is genuinely super hard to enforce. I mean, what happens if you tax a stock's rise and then it completely crashes the next year? Second, the rule writers themselves often benefit from these rules, or they're heavily lobbied by the people who do. And third, our entire economy, from how companies raise cash to how normal retirement accounts and housing markets function, is deeply wired around how these very mechanisms work. Pulling out the foundation for the billionaires could actually shake the foundation for everyone else.
The truly profound realization here, especially when we look back at our billionaire from 2007 who paid exactly $0 in tax, is that he didn't beat a broken system. Think about it. A broken system fails at its job. He followed the exact, literal instructions of a highly functioning one. He did exactly what the rulebook told him he could do. This system is doing precisely what it was built to do. It's designed to tax money that moves instantly, like the paycheck of that nurse we talked about earlier, and it was designed to leave the money that simply sits and grows, the wealth of the billionaire, almost entirely alone. Wages get taxed while wealth gets to wait. And in our economy, waiting is literally the most profitable thing you can do.
So, as we wrap up this explainer, I want to leave you with a thought. The next time you hear a debate demanding the rich pay their fair share, ask yourself this. The real question isn't whether they're paying the percentage they are legally told to pay. The far more powerful question is, who decided what counts as income in the first place? Think about that next time you look at your pay stub.